There's a moment every trader remembers. Not their first win, not the trade that made them feel smart. The moment they remember is the one where they realize they could lose everything. For me, that moment didn't come once. It came 3 times. 3 market crashes. 3 moments where the screen froze, liquidity vanished, and the rules I thought I understood simply stopped working. And each time, I learned the same brutal lesson in a different way. The market doesn't care how confident you feel right before it breaks you. Most traders never make it past their first crash. Some survive the second, but never trade the same again. Very few live long enough to see a third and still come back. This isn't a story about genius strategies or perfect timing. It's a story about survival, about what it feels like to watch years of progress almost disappear overnight, and why the traders who stay alive aren't the smartest, but the ones who learn fastest when fear takes over. I've been trading for over 15 years, long enough to see bull markets make fools look like legends, and crashes turn confident traders into ghosts who quietly disappear from the market forever. My first crash taught me fear. My second taught me humility. The third taught me something far more important, that survival is a skill, not a coincidence. And if you're still trading today, or even thinking about starting, you need to understand this story, because one day, the market will test you the same way. When I first started trading, I thought crashes were things that happened to other people. Old stories, historical footnotes, something you read about after the fact, with clean charts and neat explanations. Back then, the market felt logical, predictable. If you studied enough, followed the right mentors, learned the patterns, you believed you'd be prepared. I remember sitting at my desk during my early years, staring at charts late into the night, convinced that discipline and intelligence were enough to protect me. I believed risk management was important, sure, but deep down, I thought crashes were exaggerations, rare events, overblown warnings. That illusion shattered during my first major crash. I won't even name it yet, because the name doesn't matter. What matters is the feeling. I remember watching price move faster than I'd ever seen. Stops didn't trigger where they should. Spreads widened. Orders slipped. The market wasn't trading anymore. It was running. That was the first time I felt real fear as a trader. Not the fear of a losing trade, but the fear that the market itself had become something I no longer recognized. I survived that crash by luck more than skill. I didn't lose everything, but I lost enough to realize how fragile my confidence really was. And like most traders who survived their first crash, I told myself a comforting lie. Next time, I'll be ready. Years later, I faced my second crash, and that lie was exposed. By then, I had more experience, more wins, more confidence. I thought I understood risk. I thought I had matured. What I didn't realize was that confidence quietly turns into complacency, and complacency is what the market hunts. This time, the damage was deeper, not just financially, psychologically. I watched traders I respected disappear, accounts wiped out, years of work erased in days. That crash didn't scare me the way the first one did. It humiliated me, because it showed me something uncomfortable. I hadn't survived the first crash because I was good. I survived because the market allowed me to. That realization stayed with me for years. And then came the third crash. By then, I wasn't young anymore. I wasn't chasing excitement. Trading had become a profession, not a thrill. I thought that meant I was safe. I was wrong. The third crash didn't arrive with panic at first. It arrived quietly. Liquidity thinned. Correlations broke. Positions that should have worked didn't. This time, I didn't freeze. I didn't panic. I didn't try to be heroic. I did something far less dramatic, but far more important. I survived. And the reason I survived wasn't because I predicted the crash. It was because I finally understood what crashes really are and what they demand from a trader who wants to stay alive long enough to trade again. That understanding didn't come easily. It came from pain, from losses, from watching others fail the same test I barely passed. And that's what this story is really about. Not the crashes themselves, but the mistakes traders make before them. The mistake I made wasn't technical. It wasn't about indicators or entries or exits. It was something far more subtle and far more dangerous. After surviving my first crash, I started to believe I had earned the right to trust myself more. After the second, I believed experience alone would protect me. That belief nearly ended my career. Most retail traders think the mistake that kills accounts is overtrading, revenge trading, or bad risk management. Those are symptoms. The real mistake comes earlier. It's the moment you stop respecting uncertainty. Before every crash I lived through, there was a period where things felt calm, too calm. Profitable months, smooth execution, trades working exactly as planned. That's when the market trains you to lower your guard. I remember looking at my journal before the second crash. The numbers looked good. Drawdowns were controlled. I told myself I had finally figured it out. That sentence should scare every trader, because right after that, I stopped preparing for what could go wrong and started trading as if what had been working would continue. Positions got slightly bigger. I stayed in trades a little longer. I trusted correlations that had worked for years without questioning whether the environment had changed. When volatility hit, I reacted instead of planned. The pain didn't come from one catastrophic loss. It came from watching multiple small decisions stack up against me when the market stopped behaving the way I expected. I didn't blow up instantly. I bled. And bleeding is more dangerous than exploding, because it convinces you that you can still fix things. During my second crash, I remember sitting in front of the screen late at night, telling myself I just needed one good week to stabilize everything. One good bounce, one normal session. That week never came. The third crash taught me something even harsher. By then, I knew crashes happened. I knew liquidity could disappear. I knew risk management mattered. But knowing isn't the same as internalizing. My real mistake was believing preparation meant prediction. I thought being experienced meant I could see crashes coming. I thought if I watched enough data, I'd catch the signal early. That's not how crashes work. Crashes don't announce themselves to retail traders. They reveal themselves through absence. Absence of liquidity, absence of follow-through, absence of normal behavior. And most traders don't notice absence until it's too late. That was the pain that almost broke me. Not fear, not losses, but the realization that I had misunderstood the nature of survival in this profession. The revelation didn't come in a dramatic moment. There was no single trade, no perfect insight, no mentor whispering the truth at the right time. It came quietly, over weeks, as I reviewed my history across all three crashes. I noticed something uncomfortable. The trades that saved me weren't brilliant, they weren't clever, they were boring. In every crash I survived, there was one common factor. I stopped trying to win. I started trying to stay alive. That shift sounds obvious, but most traders never make it. Retail traders approach the market like a puzzle to solve. Survivors approach it like an environment to endure. I realized crashes don't reward foresight. They reward restraint. During the third crash, I reduced exposure before I felt comfortable doing so. I exited positions that still looked fine on the chart. I accepted smaller profits and walked away from setups that required perfect conditions. Old me would have called that cowardice. Experienced me recognized it as respect. That was the moment everything changed. I finally understood that the market isn't something you conquer, it's something you negotiate with. And every crash is the market reminding you who actually controls the terms. From that point on, my goal as a trader shifted permanently. Not to maximize returns, not to catch every move, but to remain solvent, mentally, emotionally, and financially when the market becomes hostile. That realization didn't make me rich overnight, but it made me durable. And durability is what allows a trader to still be here after 3 crashes, while most disappear after 1.
What finally became clear to me after the 3rd crash was this. Crashes don't destroy traders because they move too fast. They destroy traders because they expose how fragile most trading models really are. Retail traders believe crashes are extreme versions of normal markets. They think the same rules apply, just faster and more violently. That belief is fatal. In a normal market, liquidity is assumed. You place an order, you get filled. You manage risk, you expect stops to behave. Price reacts to levels in familiar ways. During a crash, liquidity is no longer a background condition. It becomes the main event. And most retail traders don't even realize they've been trading liquidity their entire careers, not price. Here's the uncomfortable truth I had to accept. Price doesn't move because buyers or sellers are right. It moves because liquidity is available, or suddenly isn't. Before every major crash I lived through, the same pattern appeared in different forms. Volatility didn't explode immediately. Instead, it thinned. Moves became erratic. Reactions weakened. Correlations that had held for years began to fracture. Retail traders interpreted that as opportunity. Smart money interpreted it as warning. This is where the gap between surviving traders and everyone else becomes visible. Retail traders rely on confirmation. They wait for signals to look clean, for setups to align, for confidence to return. Smart money does the opposite. They reduce exposure when things still look fine. I remember studying my trade logs after the 3rd crash and noticing something I had never paid attention to before. My worst losses didn't come from bad entries. They came from trades that should have worked based on historical behavior. That's the trap. Most retail strategies are built on the assumption that the future will resemble the past closely enough for probability to hold. Crashes exist to break that assumption. When liquidity dries up, probabilities collapse. Edge disappears not because your strategy is wrong, but because the environment no longer supports it. This is why so many experienced retail traders die in crashes, while beginners sometimes survive by accident. Beginners are small, they're underexposed, they hesitate. Retail traders are confident, they size up, they trust systems built for stability right before stability disappears. Now compare that with how smart money operates. Large players don't try to trade through crashes. They reposition before them. They don't need perfect timing. They need asymmetry. Before the 3rd crash I lived through, I noticed institutional positioning shift in subtle ways. Not dramatic sell-offs, just reduced participation, less commitment, more optionality. Retail traders saw chop. Institutions saw fragility. Here's the case study that finally made this undeniable to me. During the 2nd crash I lived through, there was a widely followed index that had respected a particular range for months. Retail traders kept buying the lower boundary, convinced it was strong support. Volume looked healthy, indicators confirmed. But beneath the surface, liquidity was being consumed, not replenished. Each bounce required more effort and produced less follow-through. Smart money wasn't defending the level. They were letting retail defend it for them, while they quietly exited elsewhere. When the break finally came, it wasn't violent at first. It was empty. Price didn't collapse because of aggressive selling. It collapsed because there was no one left to absorb the sell orders. Retail traders experienced it as panic. Smart money experienced it as execution. That's when I understood something most traders never do. Crashes aren't driven by fear, they're driven by absence. Absence of liquidity, absence of participation, absence of support that retail assumed was real. This is why stop losses feel useless during crashes. It's not that stops fail, it's that they trigger into a vacuum. And once you understand that, your entire relationship with risk changes. You stop asking, where should I place my stop, and start asking, what happens if there's no one on the other side of this trade? That question saved my career, because it forced me to accept a truth that most retail traders avoid. Survival doesn't come from predicting crashes, it comes from recognizing when the market is no longer obligated to behave normally. By the time panic is visible, the damage is already done. The traders who survive aren't faster, they're earlier. They don't wait for fear, they respond to fragility. That's the edge no indicator can give you. And once I internalized that, crashes stopped being mysterious. They became inevitable, but no longer fatal.
After the third crash, I stopped asking the market to make sense to me. Instead, I started asking myself harder questions. What would I do if liquidity vanished tomorrow? What would I do if correlations broke again? What would I do if the market refused to reward patience? Those questions changed how I traded, not in dramatic ways, but in quiet, uncomfortable ones. I stopped measuring success by how much I made in a good month. I started measuring it by how little damage I took in bad ones. The first thing I changed was exposure. I no longer needed to be in the market all the time. I learned to stay small when conditions felt fragile, even if setups looked perfect on paper. That decision cost me opportunities, but it saved me longevity. The second change was psychological. I stopped trying to be right. I stopped defending ideas. Before, when a trade didn't work, I would explain it. Now, I just exit it. Crashes punish explanation. They reward obedience to reality. The third change was how I defined preparation. Preparation wasn't about predicting the next collapse. It was about accepting that collapse is part of the profession. I began trading as if the market could turn hostile at any moment, not because I was afraid, but because I finally respected it. That mindset filters everything. You stop chasing every move. You stop increasing size just because confidence feels high. You stop believing that a good run makes you immune. Most retail traders never make this shift because it feels like giving up potential. In reality, it's choosing survival over ego. And here's the part no one likes to hear. If you can't survive a crash, your wins don't matter. If you can't stay in the game, edge is meaningless. The market doesn't reward intensity, it rewards endurance. I've met traders who were far more talented than me who disappeared after their first or second crash. Not because they were stupid, but because they couldn't accept restraint. They wanted certainty. They wanted validation. They wanted the market to behave. The market never does. The reason I survived 3 major crashes isn't because I learned how to avoid pain. It's because I learned how to accept it early, in smaller doses. That's the real application of experience. Not confidence, not fearlessness, but the ability to step back before damage becomes irreversible. And if you're listening to this and wondering whether you'll survive the next crash, you're asking the wrong question. The better question is this: are you trading in a way that allows you to be wrong and still continue? Because one day the market will remind you that being wrong is unavoidable. What matters is whether you're still here afterward. I don't tell this story to scare you.
I tell it because survival is the part of trading no one markets, no one celebrates, and no one brags about. Yet it's the only reason any long-term trader still exists. Crashes are not anomalies. They're the exams this profession uses to decide who stays and who leaves. You won't pass them by being smarter. You won't pass them by being faster. You pass them by being honest with yourself about risk, about exposure, about what you actually control. If you take one thing from this story, let it be this. The market doesn't owe you continuity. Your strategy doesn't owe you consistency, and confidence doesn't owe you survival. You earn survival through respect. Respect for uncertainty, respect for liquidity, respect for the fact that this game outlives all of us. If you're still here after 3 crashes, you stop chasing proof, you start building durability. And if you want to learn how to trade in a way that keeps you alive long enough to grow, not just during good years, but through the bad ones, then stay with this channel. Subscribe. Join the conversation, and tell me in the comments how many market cycles you've lived through so far. Because the longer you stay, the more this stops being about money and starts becoming about mastery. Master yourself, master the markets.